If silver gains 75 times relative to stocks and gold gains 15.8 times relative to stocks, then silver outgains gold by 4.7468 times. That puts silver, now if you multiply the current price of silver by 4.7468, that's $159.35, $159.35 if gold stays static. So you take the static price of gold right now, which is $29.53, divide it by 159.35, and you get 18.5 gold to silver ratio. So that does mean that in that 1980 scenario, we will be heading towards a 15-to-1 ratio. The point is, once we get a 75 times revaluation of silver relative to stocks or a 16 times revaluation of gold relative to stocks, we'll be around a 15-to-1 ratio, and you should sell your silver for anything you can buy.
Silver's relationship with the S&P 500 differs from gold's, as its inverse correlation is not as strong. While gold tends to rise when stocks fall, silver is influenced by its high industrial demand, making it susceptible to different market forces. Historically, silver has often declined alongside equities during sudden stock market crashes rather than acting as a hedge. Since the 1970s, silver and stocks have responded differently to various economic events, and in bearish periods for stocks that have been bullish for silver, the silver to S&P 500 ratios have reached significant highs. A key factor in this dynamic is the stark contrast in their current valuations. Stocks have reached record highs for over a decade, with gains of 15% year-to-date despite recent declines. Meanwhile, silver has endured a prolonged bear market, leaving many primary producers struggling to profit. Rafi Farber from Endgame Investor believes that during a crisis, gold's purchasing power could increase by about 15.8 times compared to the S&P 500. Silver is projected to outperform gold by approximately 4.75 times, potentially reaching $159.35 if gold stays the same. A rise in the silver to S&P 500 ratio could indicate significant losses in the stock market. If silver returns to its 2011 high of $50, more than tripling from current levels, the S&P 500 could lose over half its value. Ultimately, historical trends indicate that silver could undergo a significant revaluation relative to both stocks and gold, positioning it as a strong asset for those anticipating a shift in the financial system. As of Friday, the gold-to-silver ratio stood at 88.31, essentially unchanged from the previous day's 88.30, reflecting the ongoing imbalance between the two metals in the current market environment. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So this is the silver to S&P 500 ratio. There's a few key things that you should recognize from here, that you should notice from here. So this is the ultimate high of silver relative to stocks, and that is about 0.45. If you look at the intraday low for the NASDAQ and the intraday high for silver, silver was about 50, and not the NASDAQ, the S&P 500 was 110. So that is a 0.45 ratio, and we're now at 0.006. So assuming we get to a 1980 high, and we will at some point in a monetary crisis, stocks should fall relative to silver by 75 times in purchasing power. So all the purchasing power will descend from stocks and go into silver especially. The other thing I wanted to point out about this chart is that the starting point for the bull market of 1976 to 1980 was a ratio of about 0.04. Something like that. So the high of 2011, when silver next hit $50, right? The high relative to the S&P 500 was the starting point for the 1976 to 1980 bull market. The low point of that bull market was the high point of 2011 when silver hit $50. We're now at 0.006. And we cannot get much lower than here. So we're looking at a rise of 75 times in purchasing power for the silver holders versus the S&P 500 stock index holders. Now, if we compare this to gold, we have a high of 7.9 on this ratio. We're now at 0.5, whereas we started at 1 in 1977, and we got to 7.9. Now we'll be starting at 0.5, and we will head there eventually in a monetary crisis, and that translates to about 15.8 times. So gold will rise in purchasing power 15.8 times relative to the S&P 500 in a 1980 end game scenario. Now, if you do the math on 75 versus 15.8, you get something interesting. So here, back near 15 to 1, let's do some math. If silver gains 75 times relative to stocks and gold gains 15.8 times relative to stocks, loosely defined as the S&P 500, then silver outgains gold by 4.7468 times. That's if you take 75 divided by 15.8, you get 4.7468. That puts silver. Now, if you multiply the current price of silver by 4.7468, that's $159.35, $159.35 if gold stays static. So you take the static price of gold right now, which is $29.53, divide it by 159.35, and you get 18.5 gold to silver ratio. So that does mean that in that 1980 scenario, we will be heading towards a 15-to-1 ratio. I don't know if it's going to reach exactly 15-to-1 or if it's going to stop at 18.5 or 17 or 16. But the point is, once we get a 75 times revaluation of silver relative to stocks or a 16 times revaluation of gold relative to stocks, we'll be around a 15-to-1 ratio, and you should sell your silver for anything you can buy.
Rafi Farber suggests that if silver breaks $35, it could rally toward $50. Beyond that level, some analysts view it as the end game, where derivatives fail and silver temporarily remonetizes near its historic 15-to-1 ratio to gold, signaling a significant financial shift. Silver advanced nearly 4% last week, reaching its highest level since late October, as traders reacted to softer inflation data, Federal Reserve expectations, and strong gold prices. However, renewed stock market volatility and a late-week rebound in equities pressured both silver and gold, leading to a partial retracement of gains heading into the weekend. By the end of the week, silver dollar settled at $33.80, marking an increase of $1.28 or 3.93%. From a technical perspective, silver remains bullish on the weekly chart despite Friday's profit-taking-driven pullback. In the short term, maintaining support above the retracement zone between $32.53 and $31.81 will be crucial to sustaining the rally and keeping the metal on track for a move toward the following resistance range of $34.87 to $35.40. The longer-term outlook remains firmly bullish as long as silver holds above its 52-week moving average at $30.07, reinforcing its upward momentum in the current market environment. Let's get back to the interview.
The Comex silver stocks going back all the way from 1971. We can see just the history of what has happened in the previous price spikes and the supply spikes versus what is happening now. So we have these rectangles. This is the 1980 spike here. You can see what was going on in the physical stocks. They were rising somewhat, but not to the highs of 1971. They were rising a little bit. So we had a rising silver supply and a raising silver price. Here, we had an all-time high from that time in the mid-90s of silver supplies on the Comex, and we had a major low in the silver price. I think the low was something like $5 or something crazy like that. In 2011, we had a falling silver supply, slightly falling. It didn't really fall that dramatically, but we had the spike to $50 over here. And over here, we had an all-time high that was only recently broken in the silver supply. This is around silver squeeze in February 2021. And we had a local high in the price here. And then supply started to fall. The price started to fall. But what's going on now is the fastest spike in silver supply ever. This is about 3 months worth of bars here, and it's gone from about 310 million to 436 million ounces. And the price has been trying to break through 35. We can see here a little bit of resistance. What is going to happen here? Hard to tell. I think the price is going to finally break out, and we're going to head towards 50 finally. The question is, once we get to 50, what happens then? Is it endgame? Is it not? I think there's a very good possibility that it could be once silver breaks 50, we could be on a beeline to the end game, which means that gold derivatives will no longer function, and for a brief amount of time, silver will be remonetized at the historic monetary ratio of around 15 to 1. Our math today showed that it could get to around 18.5 to 1, but it doesn't really make that much of a difference.
Silver's market trajectory continues to capture attention as it navigates between industrial demand and its historical role as a monetary asset. While its correlation with equities differs from gold, silver's potential for revaluation remains a key point of interest, especially amid economic shifts and financial uncertainty. With technical indicators signaling a strong upward trend, the possibility of silver breaking through key resistance levels could reshape its standing in the broader market. Silver's next move could prove pivotal in the long-term financial outlook as investors assess the evolving landscape. Will silver reclaim its historic valuation relative to gold, or will industrial demand continue to shape its market behavior? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.